Your most recent global CIO note says there's further upside in equities, and I know that the U.S. is your preferred region. Why is that?
Well, because it simply is the market where liquidity comes together. It's also the economy that has, let's face it, there's no other economy in the world that has as many world-class companies as the U.S. have. And whether or not we like quantitative easing and low interest rates, the reality is declining yields are bullish for equities because they raise the equity risk premium, which also in the United States, but even more so in the rest of the world, is still at a record high. But then again, the short-term view is this market is driven by investors who have been sidelined, who have been on the sidelines for much of this bull market. It's a deeply unloved bull market, and I've said this many times. Bull markets don't die of old age, they die of euphoria. And this market is as different from a euphoric market as I can tell. And the US economy and the US market is the most attractive to us.
Burkhard, I got to ask you, because you're not only a PhD of economics at St. Gallen, you've also been a professor there and at MIT. And what do you make of the repo situation last week? Are you concerned about liquidity in the US?
No, I'm not. I think it showed the fundamental strength of the Federal Reserve being able to step up at times of liquidity need. I was at Jerome Powell's speech in Zurich just about 2 weeks before this happened. And guess what? Jerome Powell actually talked about such instances and the ability of the Federal Reserve to buffer such liquidity needs. And that is exactly what happened, and that's what it has shown.